Thank you for joining us for our Accelerate session. Our guest today is my accountant, James Mansfield. James is actually, full disclosure, my next door neighbour as well. He hasn't always been my accountant, but has been, for a few years now, and is doing a great job. And I thought he's helped me so much with my own gym and just making sure I understand my financials. So I wanted to bring him on today so you guys can pick his brain as well. Welcome to the call, James.
Thanks, Steve. G'day, everybody. So I guess Steve spoke to me during the week and asked if I would come on and say a few words, maybe give some hints and some tips to you guys about better understanding your business and ways that you can essentially read your financial statements to benefit you guys in terms of knowing what break-even points are, knowing your cash flow position at all points in time. So, I think we'll kick off by, explaining why it is important to have a basic understanding of your financial statements. So I'm an accountant here on the Northern Beaches, and we look after many small businesses, including quite a few gyms. And we always emphasise to our clients that it's all well and good to know how much cash you've got in the bank at one point in time, but you need to have a basic understanding and be able to read and understand your financials. And why we believe that is important is because, one, at all points in time, you need to know how the business stands. So what income you're generating on a monthly basis, and most importantly, what your expenses are. That obviously leads down to what your profit is going to be per month. One of the huge things about business is understanding what your expenses are and knowing what income you need to derive, whether it's monthly, quarterly, yearly, in order to cover those expenses. So one of the hugely important things in terms of running a business is knowing where your break-even point sits. So essentially, with you guys being in the fitness industry, it's relatively easy to figure out. Obviously, most of you will charge on a membership basis, whether that's weekly, monthly, fortnightly, however you guys choose to charge that membership basis. But knowing what your expenses are, we can then look at how many members we have and how many members we need to have in that gym in order to cover those costs. So if you were to look and you say my monthly expenses are $10,000 and you charge each member a monthly fee of $100, obviously then you know that you need 100 members to cover your costs. So anything above that 100 members is going to be profit. So understanding that and putting it in a simple way in terms of knowing how many members you need to cover those costs, and because you have an understanding of what the costs are in your business, by having that membership number obviously drives you and allows you to know where your business sits just by the amount of members in the business. Does that make sense to everyone?
Yeah, it's good. It's definitely that first milestone, I think, when we open our gym, is understanding when does it stop costing us money and we cover our expenses. And then I think what a lot of us do, like Jeff and Christian has just joined us, Christian's based in St Ives. I think we're also interested in break even once we add maybe a manager or something like that.
Correct.
So if I don't want to go into the gym all the time, I want to look at, okay, well, that was break even when I was doing everything. But now I've added a $70,000 a year wage for my manager, Sean, which equals X number of new members. And then I go, okay, I'm still taking the same amount of money out of it. But so I love that sort of calculation for different phases in our business as well.
Correct. So by understanding what your general expenses are, you can then basically easily calculate, like Steve just said, if we want to bring in, X amount of employees, well, then what does that look like in terms of how it's going to affect our profit? So if you know that you want to bring a manager in, I need another 50 members to be able to take home the same amount of money that I'm taking now. Yeah, it's also about knowing, in terms of having an understanding of running a business is not only do you have the wage expense, you've got a workers' comp expense, you've got a super expense. So that wage doesn't equal what you agree to pay them. There are on costs there associated. So, I mean, that's the importance of understanding the expenses and the income that you're generating through your business on a monthly basis. By having an understanding and an accounting software or product like a Xero and MYOB, that information can be obtained easily. So as long as you're keeping your bookkeeping up to date, it's a click of a button to see how the business is standing at any one point in time, whether your expenses have changed over a period of time, therefore you need to adjust that break-even number of members. The other important thing about understanding your business is about knowing what liabilities are due and when. So that's a cash flow issue, right? So it's obviously all well and good to say I've got a big profit in the business and I've got all this cash in the business, but if that then leads to large tax liabilities, you need to know when that tax liability is due so that you can account for that in your cash flow. Same with your GST, your wages tax, all of those types of things. So having a basic understanding of your business allows you to manage your business a lot better. It allows you to set goals. Another important thing that it allows you to do is budget and forecast, right? So it's important that when you're running a business, especially if you're looking to run a business that's going to grow into the future, having a budget is important. So basically a budget is forecasting what expenses you're going to have over 12 to 24 month period, forecasting what your memberships are going to be or what your income is going to be. And then each month goes past, you can measure your performance against that budget. So that obviously allows you to see whether you're hitting your targets or whether you are falling behind, whether your expenses are growing and you're not realizing. Obviously, with the cost of living, everything's becoming more expensive. So if you're not on the ball with that sort of stuff, then you can find yourself in trouble if you don't look at your financials, you don't have a basic understanding of your financials. You can get yourself in trouble over a relatively short period of time. So knowing where the business sits in terms of expenses and income, but also knowing what liabilities are due and when they're due. There is things in terms of compliance with the ATO. The ATO are really doing a push at the moment in terms of superannuation. So here we've had a few of our clients get reviewed because they've paid superannuation late. So things like that, knowing when things are due and paying them on time keeps you out of trouble and keeps your cash flow in check. So getting back to that superannuation example, one of the things which is absolutely crazy, but what the ATO do, so if you don't make your superannuation payment on time, so superannuation is payable quarterly, you can pay it monthly, but it's payable quarterly, by the 28th day after the end of the quarter. So if you're looking at the December quarter that's just passed, the super is due on the 28th of January. If you don't pay by that date, technically you're then meant to pay that superannuation to the ATO. So the ATO then calculate a small interest portion from when it was due to when you lodge the forms with them, and then you make the payment to the ATO, and then they disperse the money to the employee's superannuation funds. If you pay it direct to the employee's superannuation fund, what happens is if the ATO then review that 2 years later, even if you've paid that superannuation payment 2 weeks late, they charge you interest from the date it should have been paid to when they do their review 2 years later.
Ouch.
What it also means is that the superannuation payment becomes non-deductible because it's been paid late. So that can have huge tax ramifications. If you've got a few employees and you make a superannuation payment late, and therefore that deems that superannuation payment to be non-taxable, it ends up costing you a lot of money. So things like that, having an understanding of how your financials look when your liabilities are due and making sure that you're complying with all that legislation, it just keeps you out of trouble so that you don't find yourself with issues at a later stage.
Let me give a couple of examples for some of the things we've discussed. So if you're trying to forecast for 12 or 24 months, we originally did like a shadow mortgage on our gym equipment.
Yes.
So at the end of like 3 to 5 years, I think you own a lot of the fitness equipment outright. So one of the forecasts was if we still have the same number of members and then our loan repayments cease, our additional profit goes through the roof. The other stuff we could add into that is, well, when we put our prices up, like $2 per week per member, when our rent goes up and another expense goes out next year. So it's good to sort of have a few of those things to see that, okay, we're on track at the moment, but when those changes occur that we know are about to occur, how much further in front or behind are we going to be?
That's right. And we've had a lot of those conversations with some of the gym owners that we have with, rising cost of electricity. Some gym owners, especially ones that are starting up, are financing equipment, and finance costs, obviously, with interest rates on the rise, are, huge at the moment. So you need to have a look at what those costs are and how they are rising, and then determine whether you need to. You've got two options, obviously, to cover that. You've got get more members. So therefore, do we spend more money on marketing? How do we generate that? Or do we increase our prices? So they're the things that, like Steve said, they're the things that you need to be aware of so that you can be in front of the game. Because if you go a year down the track and you're paying high interest charges because you've got a loan for some equipment, or your electricity costs are going through the roof, petrol costs, all of those types of things, it can affect that bottom line quicker than you think. So being in front of the game and obviously being able to, whether it's get more members or make the decision to increase the cost per membership per week, those are things that if you're ahead of the game, then, you can obviously not have a drop of income.
It's good. For Julie or perhaps anyone that's just joined us over Facebook, today we're interviewing James Mansfield, who is my accountant, and his practice is based in Brookvale. Does our accountancy sort of work for the gym, but also for a bunch of different gyms. And I invited him on today just to talk shop around all things so you guys can feel financially sort of literate. We spoke about the importance of understanding income minus expenses is what you're actually doing in profit. We've spoken about the importance of being able to forecast if you've got, equipment loans that are about to be paid off, or if you've got rent that's about to go up, or if you're going to do a price rise or something like that. And we've just touched on super. I just circled it 3 times that it has to be paid on time.
Correct.
Otherwise, you get not only interest charges on it, but it becomes non-deductible and it becomes a real problem for you. So if you weren't aware that's a real non-negotiable particularly for me and James when we're talking. Let's get that paid. Make sure we never get that sort of penalty. Can we just talk about super for a second? So for those like Australian gyms that have joined us today, we're currently, what are we? 10.5% super, which goes up to 11% on the 1st of July. And then 11.5% on the 1st of July in next year. And then it goes to 12% on the 1st of July in 2025. Mm-hmm. So there's like a 0.5% sort of increase, so that, I think the Australian government have realised that we've got this ageing population. They know that we've got to start contributing as small business owners more to what people have got when they finish work. So as a small business owner, we're paying a little bit more than we used to. Any sort of recommendations around super? Like you said, you pay quarterly, you pay it on time, so you don't get any issues there. I know you sometimes encourage me to contribute more to super. Are you able to share any point on that?
Definitely. So essentially, if you're under the age of 55, you have a what they call a concessional superannuation cap. So concessional superannuation contribution is where someone claims a tax deduction. So that's either an employer or it's a personal tax deduction. So the current the current concessional or tax deductible contribution cap at the moment is 27,500. So we use that as a good tax planning tool. So for all small business owners out there, obviously you're required to pay at present, which is what Steve just mentioned, 10.5% SGC, which is what they call super guarantee contributions. So that's compulsory. You have no choice in that. So whatever wages you pay yourself or your employees, you must pay 10.5%, and that has to be paid quarterly by the 28th day after the end of the quarter. And that's what we just talked about. There was really no way the ATO could track that previously. Now they are liaising and corresponding with larger super funds, and the super funds are providing the ATO with details as to when some small businesses pay employees late. So gone are the days where we can either forget to pay the employees or pay them late. That's gone now. So you get yourself in a whole lot of trouble if you don't do that. But what it allows you to do, if you get to the end of the year and you see that the profit in your business is relatively high, you can choose, as a way to save tax within the business, to maximize that concessional contribution. So if you've taken 100,000 in wages yourself, or you're paying a spouse or someone who's in the business that's obviously close to you, that comes with that SGC of 10,500. So you'll pay 10,500 compulsory super on that, but you've still got up to that 27,000. So you've still got 16,500 room in your concessional cap. So you can choose to make either a salary sacrifice contribution into super from your business. So your business then gets a tax deduction for that up to 25 or 30%, depending on what your tax rate is. And the super fund will only pay 15%. So on that top up amount that you put into super, you end up being 10 to 15% better off for tax purposes by doing that. There's two things that you've got to look at there. One, obviously, is then you're taking the cash, because the cash has to be physically paid. So you're taking the cash out of the business and putting it into superannuation. As most of you would know, and the ATO is making it harder as we talk, you can't access that super until you meet a condition of release. So the biggest condition of release is at the moment is retirement. So basically, the retirement age at the moment is 57, but between 57 and 60, essentially, if you go into pension phase and start drawing money out of your super, you're still got to pay tax on it. Once you turn 60, the money that you take out of superannuation is completely tax-free. So it's normally 60. So if you choose to make those contributions into super, essentially you can't touch that money until you're 60. So we encourage people to get money into super. Super's a great tax advantage at the moment. I always say at the moment, because the government always seems to tinker with the superannuation laws. So we can only obviously give advice on what the current laws look like at the moment. But basically that money goes into super. Any income that generates over the years that it's in super, you only pay tax at 15%, versus if you had it and you invested it in a company or individually, you'll pay a lot more tax than that. And then once you do go into retirement phase and you start drawing down on that super, any income within that super is tax-free. Whereas if you've got investments outside of super, even in retirement, you'll still pay tax on those. So as we speak now, it's the best tax haven that we have for when you're in that retirement phase. So it's always good to try and build your super up. In saying that, obviously, you got to have the profit in the business, and you got to have the cash in the business to be able to do it. So it's got to be basically above what you guys need to run the business or to live personally. And then you've got to be able to make sure that you don't need to touch that money until you're 60 years of age as such. So a lot of people, when they're younger, might say, well, look, I don't really want to do the top up of super because I've got large mortgages and things like that they're going to pay down, which is fine. So it all comes down to personal preference and personal situations. But as you get closer to retirement, so if you're 50 or late 40s to early 50s, we say you should have, hopefully by that stage, mortgages under control and things like that. And that's when it's a real good time to hammer your super, because obviously you don't have as long until retirement, so the money isn't locked up as much, and it's a great tax saving exercise personally, and it's an unbelievable tax saving when you're in retirement. So
Yeah, I think that sort of important takeaway is just having an awareness of the benefits of reducing the tax rate if you do want to contribute to super, but also being open with your accountant and asking questions as to what's the best kind of play for us. And I can obviously leave you James's details if you have a personal sort of question or something. You're more than welcome to sort of reach out to him after today. But at the very least, like, you should understand, me and James are going to sit down and go, okay, how did the year go? If there's profit there, I'm 44 shortly. If there's profit there, like, my first interest is actually taking some profit, even though I'm going to pay some tax, because I'll often try and invest into property or something like that. So one of the things we did last year, I was like, well, property market was sort of moving. We took some profit out of the business, invested into that. The slower, or the putting a little bit more or topping up the super was something we're able to do as well, but it's only up to 27,000 per person. So if Anna, my wife, is on the payroll, we can top her up to 27. If I'm on the payroll, we can top me up to 27. But it's, again, I can't touch it till I'm 60. So it should be something to consider, that it's like a long-term play. But if you're trying to sort of create wealth now or do something in the next 5 to 10 years, your accountant can give you a little bit of direction around, well, what's the sort of best play for my age and my business right now.
One of the important things that we always say as well is, for all of the small businesses that we look after in our practice, we have a tax planning exercise. So we do that late May, early June. And I encourage you guys, if you've got accountants out there, to contact them to get that going. So you should always have a tax planning meeting late May, early June. And what that does is that gives you an understanding of what the previous year has looked like. So then obviously your accountant should discuss some of those strategies that we've talked about in terms of topping up super. There's one of the other things I'll quickly mention now, but we can come back to also, is that instant asset write-off, because that's ending at 30 June this year. So that'll revert back to $1,500. But by having that tax planning meeting, it allows you to look how the business has tracked in the last 12 months, obviously. Have a look if there is any ways that you can reduce your tax going into 30 June, because if you go after 30 June, if anything needs to happen after 30 June, it's too late. It has to be within that period. So if there's super top-ups, they have to be received by your superannuation fund prior to the 30th of June. You can't backdate any of these things. So by having that meeting, it allows you to understand where the business sits, what tax-saving exercises are there going into the year. And if nothing else, it allows you to understand what your tax bill will be, if any. So where a lot of people get in trouble is, obviously 30 June ends, the tax returns and the tax isn't payable till May 15 next year. But during that time, a lot can change. So COVID was a huge example. So coming into sort of 30 June 2019, especially gyms was a big one, obviously. So they had a really good year. So everything was tracking normally. The memberships were going great. The profit was there, all of that stuff. So then I would say to a client, okay, you've made 200 grand profit, therefore you owe 50,000 in tax. It's not payable till next May, but just be aware that you owe that tax. Then if they go through a rough trot and they have to then use that 50,000, they get to May and they'll go, well, I don't have that money. And that's where you have a problem, right? So by going in and having the tax planning, it allows you to know what that tax bill will be. If you don't have it, and then you had a good year, and then you have a bad year, you might have used some of that tax money to subsidize the business, and then obviously you're in trouble when the tax bill comes because you don't have the cash. So it's just understanding, and again, I get back to understanding where your financials sit and knowing what your profit is and what your liabilities are and when they're due. That just allows you to manage the business a hell of a lot better. And like Steve said before as well, we always encourage, people always come to us and say, what's the way I can pay the least amount of tax? In terms of looking at a proprietary limited company, so if a lot of you guys are set up as a proprietary limited company, if you cap your wages at about $100,000 and leave the rest of the profit in the business, you're not going to pay more than about 25% of tax. But if your business is making $300,000 each year in profit, it's going to be building up a whole lot of cash within that business. I'm always of the opinion that, you know, if you work your ass off, you want to get, or you want to enjoy that money. So there's no point in just leaving it in the business. Like Steve said, you want to take some profits out of those businesses. It will cost you a little bit of top-up tax, but it allows you to build wealth outside of the company, to which obviously by building wealth outside of there, it protects it. And it also allows you to maybe top up your super and build some wealth through there rather than just leaving all the money within that company structure.
Yeah, it was definitely part of the reason why I moved on from a previous accountant. It was always just in tax minimization. And I remember at the time, I remember we had like 300 grand sitting in the business for fear of, like, don't take it out because you're going to pay a big tax bill, which is just madness, because it obviously didn't factor in anything else, like, you know, wealth creation. So yeah, I do
enjoyment, right? You got to enjoy the fruits of your work.
Well,
Everyone works hard.
And I think with some accountants, it's a bit of a dirty word to be paying a lot in tax, but yeah, tax is probably an indication that you've made a bit of money that year as well. It's a bit of part and parcel. Let's talk about
that's the saying of every accountant. When the clients don't like paying tax, we say, "Hey, if you're paying tax, you're making money, right?"
It's true. Hey, let's pause for a second. Jeff, Christian, Julie, Mick, anyone on Facebook, have you got a question for James about one of the topics we've covered so far, or maybe something different? While we're waiting for some questions to come through, instant asset write-off means that if I desperately need a piece of equipment, like some cables for the gym, is I can actually pay for it now and get those tax deductions, or is it a depreciation like up front? Is that how it works?
That's right. So previously, prior to COVID, if you bought what they call a capital asset, so that's anything that has a lifespan over 1 year. So if you buy a bit of equipment and basically they last for 5 years, then you write that asset over 5 years. So if it costs you $5,000, you get basically $1,000 deduction each year for the depreciation on that asset over that 5-year span. During COVID, they brought in what they called the instant asset write-off. So that was any asset that you purchased, and there was no limit, which was crazy. So any asset that you purchased, you were able to write that asset off in the year that you purchased it. So again, same example, if you bought a $5,000 bike or a bit of equipment, you were able to write that $5,000 off in the year. So therefore that saved you 25%, so $1,250 in tax by writing it off that year, rather than getting a $250 tax benefit each year over 5 years. So it's not as good as it sounds, because obviously it still saves you the same amount of tax, but it saves you the money now rather than over a 5-year period. Obviously, everyone knows the value of money is better now than it will be in 5 years' time. So it's just a way that you save money now. Now, what's happening is the ATO is now bringing that to a close. The close date is 30 June 2023. So we're talking in the next 4 months. So if you purchase an asset in the next 4 months, you're still able to take advantage of the instant asset write-off. If not, and you purchase it in July of 2023, the limit is $1,500. So anything over $1,500, you will have to depreciate over the useful life of that asset. So I guess my advice would be, if you guys need anything in terms of gym equipment, office equipment, anything like that, if you're going to need that within the next 6 months, then I would suggest that you go and buy that prior to the 30th of June. One of the things there is that it has to be installed and ready for use. So you can't go order something like a car or whatever and write it off if you haven't received the asset prior to 30 June. So it's got to be installed and ready for use prior to that 30 June 2023 date.
Yeah, it's good. It's like part of the Gym Hub mentoring. I often discourage people from just investing heaps of money into new equipment. I've never got a single new member because I bought a new $5,000 leg press.
Yeah.
If I was trying to increase cash flow, I would, get some more leads, sign some new members up, and that's the difference. And the sales and the marketing sort of makes the difference there. So the exception, I guess, is when something like the wheels are falling off, like you literally know that you're going to need to replace your car in the next 6 months. You're going to have to do it anyway. Or you've got something that all your members are complaining about. You're going to have to do it anyway. So factor that in. The other thing is, I think something you've encouraged me to do is look for opportunities where an expense can be put through the business. So perhaps I've got, new runners. Maybe I've got sunglasses, sunscreen. Maybe I've got car mileage or a book, or there's a whole bunch of different things. Definitely. Which, with the receipt, I can obviously claim a tax deduction on, which legally means that I have less of a tax bill at the end of the year, and I get to keep a little bit more of my my profit. Can you give us a little bit of insight? Home office is one that we claim a little bit on. What's involved there?
Yep. So obviously, especially you guys being owners of a business, it allows you to claim a few more deductions than people who are employees and things like that. So obviously, if you've got a home office set up at home, you'll have desks, computers, all of those types of things. So they're specifically bought to run the business out of your home. They are fully deductible. Usage charges of your home are deductible. So that would be things like electricity, internet costs, any of those, what they call usage charges. So they're tax deductible as well. And the way that we work out the tax deductibility of those electricity, for example, are basically they look at the size of the room or the size of the area of the home that you're using compared to the size of the home itself. And then basically you work out the percentage that area that's used for work. And that could be, garage for gym storage. If you're running a couple of classes out of there, it could be home office, all of that sort of stuff. So you take that area and you work out that over the total size of the property. And that's the percentage you can claim of electricity, gas, and all that sort of stuff. Internet's a little bit different. So internet, obviously, if you don't use much internet apart from when you're working, then we can claim the majority of those internet bills. So what we like to do, and what Steve's mentioning there, is make sure that we maximize the deductions that we do claim through the business, so that the wages that you guys are taking out of the business, you don't have to pay for those expenses post-tax. You're actually getting them pre-tax. So therefore, that might allow you to obviously have some more money personally from the wages that you take out. It even could allow you to lower your wages a little bit if you wanted to. Not that I would suggest that, but if you wanted to lower your wages, because then you don't need as much money outside of the business because you're getting a lot of those expenses. So things like all your telephones, internet costs, all of those types of things, you need to make sure that you're maximizing those deductions through business, so you're not paying for them from your after-tax wages.
It's good. Tell me about cars and travel.
Yep. So travel, we'll touch on travel first. So when the way that the ATO look at travel expenses is they want to know what the predominant reason that you are doing those travel. So let's talk overseas travel. So you're going to Singapore on a holiday. A lot of people will ring me and say, can I claim that as a deduction? The short answer is it depends predominantly what the reason of the holiday is, but you can apportion it. So if you go on a holiday and you visit gyms and you go to a course or whatever, the amount of those days that you are doing things that are work related, and where you guys, I guess, benefit are there's gyms all around the world, right? There's probably people on this call that aren't from Australia. So there's always plenty of opportunity to do things and go see things that relate back to the business that you do. So one of the big things that the ATO love are travel diaries. So if you go on an overseas trip and you diarise essentially what you do on that trip, and you include some business days on that trip in terms of going to look at gyms or going to an expo or something like that in the city that you're in, then that allows some of those travel costs to become tax deductible. It's worthwhile doing it, because if you go for a 2-week holiday and you can justify that, 4 or 5 days of that you've done some business related stuff over there, then that means that 30-40% of your flights, 30-40% of your accommodation, those types of things can become tax deductible, which obviously is a big benefit. Coming back to motor vehicles. So motor vehicles, obviously you guys being gym owners, so they have, if you're set up as a proprietary limited company, the company can own the vehicle. If it's a ute or a van, it is exempt from what they call fringe benefits tax. If it's not a ute or a van, then technically we can only claim the business related expenses associated with your petrol and rego insurance. And the best way to measure that is by doing a logbook. So what the ATO look at is they look at a 3-month period. So 12 consecutive weeks, you have to keep a logbook of all the kilometres you do in that vehicle. So every time you get in, you write down opening odometer, closing odometer, whether it's business or personal use. You get to the end of that 12-week period, and then you obviously get a percentage. So that's whether it's 80% business, 20% private, and that determines what expenses we can claim throughout the full year. So even though you've only done the logbook for 3 months, it determines the expenses for the full year. So that means you'll claim 80% of your petrol, 80% of your rego, 80% of your repairs for that period. So our advice always is that you pick a 12-week period where you use the car predominantly for work. And
you wouldn't choose the 12 weeks over Christmas if you're not going into the gym. Very
Correct.
Good. You obviously can claim like fitness stuff and list it as uniforms. You can take your clients out for lunch. I know we use a bit of stuff through internal catering and entertainment. What type of stuff would fall under those banners?
Yep. So obviously if you're running any workshops where you're providing food and all those types of things, anything like that, obviously, there's a degree where you can pull in some personal stuff into that. If you're taking your wife out to dinner and things like that, there's always, there's a business meeting and stuff like that. So those types of things, obviously you can't take it too far, but there is an element where you can claim a lot of those expenses through the business too.
Very good. Guys, any questions when it comes to maximizing deductions, just so you can keep more of the money in your pocket? Christian, Julie, Jeff, Mick, any questions, guys?
Yeah, I've just got one for you, James, relating back to travel. So basically they apportion a percentage based on how many days of your travel you spent on business-related items
That's right.
as a percentage. So, sorry, Steve. Yeah, so just working out how many days that you did. So you wouldn't obviously spend the whole day on that business-related visit to a gym. It's just how many days you had contact based on your business.
Correct. So they base it all off that travel diary, right? So if you can have evidence that you've gone and done business-related activities during that day, then that becomes a business-related day over the full trip.
So 2 days out of 10, so you'd claim 20% on the total of accommodation and travel,
flights, all that stuff.
Yep, everything. Brilliant. Thank you.
Correct.
Good questions. We were in Japan for a couple of weeks at the start of the year. Went and visited some gyms because we were going to work out anyway. Good to sort of check out what other people are doing. And yeah, you might be at the gym for half an hour, but you obviously need accommodation that day. You need food that day. So yeah, it's not hard to tie in fitness and learning a few things while you're away. So Christian said he's going to the Fitness Expo in London. We've been to Ursa and Idea in Los Angeles many times. You buy a $295 ticket for a 5-day conference. Some of it you might go to, or you might go to day one if you've got other stuff you want to do in LA while you're sort of there. So yeah, make sure it's kind of work related, but it's so cool that you have that opportunity to, I think, claim a few of these things against your business, because as James said, there's gyms everywhere, and you're probably going to go and see it anyway. Julie says, apologies, I should already know this, but how are tax deductions calculated? Julie, are you able to pop your camera on and come and join us? How are tax deductions calculated? Hang on, we've got to get your mic on.
Yeah, I'm just curious, like, do they just deduct the whole cost of the item from your profits, and then you just pay tax on your profits minus the cost of the item?
Yeah, so that's basically correct. So basically how it works, a lot of people will say to me, okay, I'm going to spend $1,000 on this, whatever it is, new telephone or whatever it is. So you don't save $1,000 in tax by having that $1,000 tax deduction. What you do is you save your tax rate on that. So essentially, if you spend $1,000, the current company tax rate for small business in Australia is 25%. So that $1,000 deduction will save you $250 in tax. So the way they work it out is they say, this is what your income is, 100,000, all your deductions equal 50,000, and that could include that $1,000 worth of new phone. So that leaves you with a profit of 50,000. In a company, the tax rate on that is 25%. So essentially, you would pay 25% of 50,000 in tax, being 12,500. Does that make sense?
Yeah. Yeah.
So for every dollar you have as a deduction, so for every extra dollar you have as a deduction, you save 25 cents in the dollar. That's the way to look at it.
Yeah.
which is pretty nuts, right?
Yeah.
Like, I know we spend a lot of our time thinking about more members and how do we increase our cash flow, but there's opportunities all around us where we can actually be using pre-tax dollars. So rather than sort of paying tax, so you earn 100 grand, you give 25% of it away, and you're stuck with 75 to then go and buy your stuff. What James is saying is there's a bunch of stuff you can probably claim that relate to your business anyway. So instead of paying tax on 100,000, you only pay tax on 75,000 or a smaller amount, and you keep more of what you earn.
Yeah. Can I ask another question? This is probably only me in this situation, but I still operate as a sole trader.
Yep.
So I know I should have made the transition to proprietary limited already. I've had my studio for 7 years now.
Mm-hmm.
And it just scares me because there's just so much more going on. I don't even know how much I should pay myself. I don't even know if there's enough there to pay myself each week. Like, I don't know.
Yep.
Like, there's just so much more to deal with. As a mum,
like you're getting stressed about it.
I know, as a mum of 3 young kids, like, I don't have the headspace. Like, I've just, when you've been doing something for so long, and it's working, but like, how much worse off am I operating as a sole trader than?
So what I'll do quickly, Julie, I'll run through the differences between obviously a sole trader and a proprietary limited company, and the benefits and I guess the consequences of not doing it versus doing it. So it doesn't necessarily mean that it's cost you money. It definitely doesn't mean that. So the benefits of having a proprietary limited company is, in Australia, there's only 2 separate legal tax entities. One's an individual and the other one's a proprietary limited company. They're the only 2 vehicles that pay tax in their own right. So a proprietary limited company is what they call a separate legal entity to yourself.
Mm.
So one of the big benefits of having a proprietary limited company is it gives you asset protection. So if someone sues you and you're a proprietary limited company, they sue the company. So they can only get the assets within that company. Anything that you own outside, being family homes, investment properties, anything else, they can't touch that unless they can prove that you're being negligent or fraudulent. Most cases they can't. So they really can only get the assets within that company. So that's one benefit. You get that asset protection. The other benefit can be tax. So obviously you can manipulate what type of wages that you pay yourself. So in a company, you have income, less expenses. Because the company is a separate legal entity, you will pay yourself a wage. That wage can change. You can take lump sums, you can take weekly amounts. Being an owner, you can make those decisions to suit what the business situation looks like. And then after your wage, you're then left with a profit, right? You pay 25% flat rate. So whether you make $1, you pay 25 cents in the dollar, or whether you make $10 million, you pay 25 cents in the dollar. So you can manipulate the amount of wages you take out. Whereas being a sole trader, the way that the sole trader works is you go income, less expenses. Because it's you, there's no wage. And then whatever that profit figure comes out at, you pay tax at individual rates. So individual rates are stepped, right? So the first 18,200 is tax free, then 18,200 to 45, you're going to pay 19 cents in the dollar. 45 to 120, you pay 32.5. 120 to 180, you pay 37, and above 180, you pay 45. So for tax purposes, if you earn about $100 to $110,000 profit a year as a sole trader, it's basically 25%. So anything above that 110,000, you're paying more as a sole trader than you would if it was in a company. But that's only if you left profit in the company. If you said, okay, I make $200,000 a year as a sole trader, so yeah, I'm paying more than a 25% tax rate. But in a company, if you said, okay, I need to take that 200,000 as a wage, you pay the same amount of tax, right? Because it just leaves no profit in the company and you've taken it all out as wages and paid tax at individual rates. So the only benefit for tax purposes, if you've got the ability to say, okay, I'm only taking 100 wage and I'll leave the rest in the business, because that's when you pay a lesser tax. Now, with a company, obviously you've got setup costs, you've got higher accounting costs, the wages that you take out, you've got to pay workers' comp on that wage for yourself. You've also got to pay the 10.5% super, which I always say is not a bad thing because it's still your money. But so the costs with running a business and the on costs, even on your wages, is more. So essentially the costs are higher by having a company, but you get that asset protection. And it also gives, depending on the amount of profit that you are making, it gives you the ability to maybe pay a little bit less tax in that company structure. So you're looking at about 100 to 110 individually as a sole trader. You're going to be paying the same taxes in a company. It's about 25 when you stretch it over the thresholds.
Yeah. Okay.
Does that make sense?
Yeah. And probably more than the differences in tax, or that it's probably more the asset protection. That's I mean, I knew about that already, but when you just mentioned, family home, now that I've got this new home and that sort of does trigger.
Yeah.
But it's good to know that, tax wise, I'm probably the same.
Probably pretty similar. Yeah.
Unless you keep making more money.
Yeah. But I wouldn't stress about in terms of knowing what wages to take, because you can start yourself off, at a minimal amount or whatever, and then each month you can have a look at what the profit looks like. And that's where I was talking about understanding your profit in your business, because then you might say, okay, if you understand what your expenses are, well, I know I can afford, $1,500 a week. And then every month you might say, oh, I'm going to take a $5,000 bonus, or I'm going to take a $10,000 bonus at the end of the quarter. So you don't have to take a steady wage each week.
Okay, yeah.
Being an owner in a business, you can do whatever you want, basically. I always say it's good to take, a standard weekly wage. And then if it allows you, or you need more money, we just look at each month, see what the profit looks like, and then pay a bonus. So
All right. I just thought you had to pay yourself the same each week, and I was like, I have no idea.
No.
Like,
you can do whatever you want.
Need more, some weeks you need less. Like, I don't know.
Yeah,
anyway,
good.
Okay, good. Thank you.
No worries.
Great question. Yeah, like I'm set up as a company, sort of mindful that if it was sort of me doing most of the sessions, it's a fair bit of control over what's sort of happening there. I feel a little bit more vulnerable that I'm not in there, and there's 10 staff that someone might get injured or choose to sort of sue us or something like that at some point. So it's just that sort of layer of protection which I sort of prefer.
And we sort of say, obviously, the bigger you get, it's better to be a company, especially if you start getting employees and things like that, because then obviously you need to assess the risk, right? So you say, well, look, what risk is there in my business? Once you start employing people, there's employment risk, because we know that today's society, a lot of employers get sued. It could be a number of reasons. Then you've obviously got the members, so you guys carry a bit of risk there, especially with, obviously lifting heavy weights and doing a lot of those sorts of things. So you assess the risk, and then you say, okay, like people might say, well, look, yeah, there's a little bit of risk. We do a lot of outdoor stuff, so there's not too much risk. Plus, I don't really have too many personal assets that I need to protect. So then the advice might be, well, in your scenario, with the limited risk and the limited personal assets, it's cheaper for you to stay as a sole trader. And you can always change, Julie, don't get disheartened. You can always change it at any point in time. So you could say, from 1 July this year, I'm going to start a company and I'm going to run it through the company. So that's easily done. So you can always jump. So we will always assess the situation of the person and say, okay, you don't have many personal assets. There's limited risk in the business. It's cheaper to be a sole trader, and it's not going to cost you any more tax. So stay as a sole trader. But then if we start having employees and your income starts going up and all of those types of things, well, now is a good time to then jump into a company.
No, good. Any last questions, guys, before we let James start off and get to his next client for the day?
No, thank you.
No worries.
Too easy. So, guys, if you joined the call late, we're interviewing James Mansfield, who's a chartered accountant. His practice is based in Brookvale, and he's my accountant. He's actually my next door neighbour as well. We're often talking shop, business-wise, and that's what I enjoy about having an accountant. It's not data entry, but instead we're having conversations around, well, what are the implications of doing A versus B? If you have more questions, go and make that. Remember we spoke about if you want to do tax planning, you do it before June 30, not afterwards, because there's not much you can do afterwards. So for those of you that are based in Australia, get an appointment in with your accountant. Make sure you're having conversations, not just about tax minimisation, but what's like the wealth creation plan? Are we taking money out to go and invest into something because that's the plan, or are we minimising tax by leaving it in there? Try and find a plan that actually suits you. I'll leave James's contact details in the thread where this video has been projected into Facebook. If any of you have questions or you want to sort of chat to James about stuff that maybe came up on the call today, feel free to sort of reach out to him. But James, thank you so much for your time today. I really appreciate your help. It sort of gives me a bit of a headache talking about these things the first time, but the more you and I talk, and I'm like, yep, I understand that. All the sort of stress comes out of it because there's certain rules to play within, and we just make sure that we play to the rules. If it was a sport, you play to win, and knowing all the rules is the important part. So I appreciate all your help today as well.
No worries. Happy to help.
No worries. Thanks, guys. You enjoy the rest of your day. We'll chat soon.
Thanks,
James.